So good morning, everyone. I'm here with Tricia Kemp, who's one of the co-founders and a general partner at Oak HCFT. So I'm going to start off by asking you sort of a general question to set the scene, which is, what have you guys been up to over the past 12 months? What have you invested in? What have you looked at?
Yeah, no, absolutely. Thank you, Anna, and we're delighted to be here. And we follow a lot of Hans's themes, but we largely look at B2B solutions. You know, we divide the world into a series of stacks: payments, lending, asset management, capital markets, mortgage, insurance, real estate. And we look for solutions up and down those stacks. Recently we have spent a fair amount of time, like everybody else, kind of in the AI world, but we've kind of, not only is there AI needed in all levels of those stacks, but you also have the whole issue of the data. So we've had a couple investments lately that are actually, cleansing and organizing the data before they even get to being where some analytics or an AI engine could be put to work. And many use cases within financial service solutions, mortgage and loans and taking out a credit card and, cashing checks, et cetera, have paper involved, and there's data involved in that paper. As a general statement, we're trying to optimize, looking for solutions optimizing all those processes. But if you then kind of look at the data there, before you can actually get to having an intelligent engine, you actually have to have organized data. So we've had a couple investments lately in the insurance space. One is Clara out in San Jose. A second is Groundspeed in Ann Arbor. One is doing workers' comp claims, and one's doing commercial insurance. And a big portion of what the solution they're providing is actually taking data from carriers or others, organizing it, processing it, templating it, so that you can then apply some intelligence to it. So the AI across all portions of fintech, and related to that is the data. And everybody knows that financial services companies are the greatest buyers of data in the U.S. I forget what the percentage is, but compared to other verticals. We've spent a fair amount of time lately in Israel, and have had 2 recent investments out of Israel where commercialization is coming to New York. And as many know, very strong payment, security, reg tech environments, and engineering talent. So those are where we've kind of had 4 or 5 investments in the last number of months. But the themes, we're kind of consistent in our themes. I mean, we laugh, we kind of call payments, the gift that keeps on giving. Like we started like in, 04, 05, and wow, look at this, payments are going to go digital, and here we are, right? And everybody knows B2B payments are way behind consumer payments, and there's, lots of opportunity kind of vertical by vertical if you can get those ecosystems working. I think Visa, I didn't read the detail, I think Visa even announced yesterday a new solution, maybe called, I don't know what, B2B Connect or something. And you read percentages of anywhere to 50 to 70% of payments coming out of CFO's office are still some way manual. Payments, data, reg tech, regulatory compliance is still a huge opportunity. And these opportunities haven't really changed. So in light of St. Louis winning last night, you can say, okay, go to where the puck is going, right? But must not have any hockey fans here, but to go to where the puck is going. But a lot of these themes have been consistent for 10, 12, 15 years, and not many of them have completely played out.
Mm-hmm. And going back to data,
yeah.
Do you think, because we hear from I speak to big financial services companies, and everyone's doing something on AI, and they have a bot and machine learning and all this fancy things. But do you think it's a bit early for the fancy things, and it's best to invest in sort of the cleaning up part for now and the organization? Or
well, you got to do both. I mean, you got to do all of it, right? But if the data's not good going into it, then the decision's not correct, right? And there are all these terms out there, supervised and unsupervised AI, et cetera, and attended and unattended, and you kind of have to have the right level of intelligence in the data. Yes, with good data, there absolutely are lots of things that can be done frequently with supervision. No, we don't think AI is overrated. We just also think there's an opportunity we have one company where it's literally consumer loan documents, and they're pulling out all the data out of the documents, and they're organizing it, and they're keeping it, for a financial services company, and then they're feeding it into their loan management system. And adding the analytics on top of that is a whole nother opportunity, but just doing the first part is worthy.
Do you see big banks and insurance companies, big incumbents, react differently to sort of the companies you've invested in? Are ones more welcoming? Is the adoption different at this stage, or?
Yeah, I'd say, and this is all anecdotal, but I'd say over the last decade, you've seen a big shift in the sense of, I'm aging myself with this comment, but in the old days, everybody would say, well, you buy IBM, you're not going to get fired by buying IBM. And today, whether it's a top 3 bank or a top 3 processor, whatever it is, they want the 50 engineers in Midtown Manhattan who have got a better solution than their 5,000 can build. So I actually think you have a much more open environment, and much more of an opportunity for an earlier stage company. It takes a long time, but to land one of these big contracts because they're willing to go with them, whereas I think that a decade ago they were far less willing to go with them.
You mentioned payments, the gift that keeps on giving, and now it's also giving some exits, I guess.
Yes.
There's been so much consolidation. How does the consolidation this year and just the M&A, how does that inform your thinking now as you invest?
Well, I think that, well, first of all, I think it validates the fact that I think payments, kind of continue to go up and to the right? There are lots of different parts to payments, and so parts of payments are highly commoditized, and you just need volume. But lots of the folks who are being purchased at higher than average multiples have something proprietary. They either got a proprietary slice of customer they're going after, they have proprietary technology, they have a fraud engine that is worth it, so that the multiple being paid, the acquirer is just not buying volume, they're also buying an asset with that volume. That then gets, validates kind of the higher multiple. I think you're going to continue to see consolidation because a lot of it, can be I'm going to use the term commoditized, and it's not there yet. Parts of it are. I think you're going to continue to see consolidation because, scale gains leverage and margin. But there's lots of opportunities in different verticals. There's lots of opportunities cross-border. There's lots of opportunities, in other countries.
So you don't think that the fact that there will be more consolidation means that competition will start getting really tough if you want to start?
Well, yeah. I mean, yes, you could argue that, but you have to have something different. I mean, you could have argued that about, money remittance, and lots of, money remittance, early stage money remittance companies have gone well. And you've always said, well, gee whiz, Western Union's just going to come in and undercut them, and they're not going to have the same FX margin, and they've done quite well. And so, you have to have a different consumer experience or a different, business experience. You have to be offering something, right, that is of value, and that will then be of value upon your exit.
So what are some of the areas that you deliberately avoid, and that if you see a pitch, you're going to say no to back off? It's very hard to convince you.
Well, we're harder to convince on direct to consumer because a lot of that is a marketing game. So we're a lot easier to convince on B2B. I think, Europe, GDPR, open banking, we probably waited to see that play out more, and we're harder to convince, and sort of the ramifications of that. I think that if you could say, okay, what were you harder to convince on, what surprised you? All the challenger banks and neobanks. I mean, I think that there's been a little bit of a shift there. I think we would have thought, okay, it's a checking account and a card attached to it, and maybe you get an overdraft or you get an advance against what's coming in for your paycheck. How differentiated is this? And everybody starts with the same service or solution, and then they have to sell into other ones, and it doesn't matter whether you're SoFi coming from this direction or somebody else coming from that direction. But as we all know, many of them have gotten very high valuations and are continuing to grow, and so I think that that sort of direct to consumer, a lot of it is a marketing capability, right? We stayed away from, and many of them have done very well.
So we were talking about valuations backstage.
Yeah.
Does the higher valuation necessarily mean that they're actually sustainable going forward?
Well, I don't know. We're going to find out. So first of all, if you go find the actual facts, I think that you compare 2018 to 2013, 5 years earlier, I think A's and B's in the US are 4x valuations for the same scale company, and I think C's and D's, A's and B's are 2x, and C's and D's are 4 and 6x, right? So the valuation at the later stages is even scaling higher. I think, we all hope these multiples hold for lots of reasons. I mean, either upon exit, I guess, for us, it's on both sides, on entering or exiting. But, I think you would say that what's happening is a recognition. You have high recurring revenue, you have high data assets, you have a proprietary either tech or data platform, and that it's got that value for incumbents. Mm-hmm. Many of our companies have tended to sell to strategics versus IPOing. And again, what they're looking for, and I think we've had now, 57 companies in the last 12 years, and what the strategic, and the vast majority have gone to strategic acquirers, and they're looking for some sort of tech asset or data asset that they otherwise would take too long to build themselves. Mm-hmm. And so they're willing to pay a high multiple for that if they're able to spread it across their greater consumer base, or it's going to take them customer base, or it's going to take them too long to build it themselves.
Are there geographic areas where valuations are a bit more in line with reality, or is it like fintech everywhere?
Well, fintech's kind of fintech everywhere, but and this might not be true in the last 6 months, but if you looked the last couple of years, outside the Bay Area was half the valuation of the Bay Area. So, and we're New York City area based, and one of the advantages in our portfolio, yes, we have many in California, but the majority of it is outside California. The valuations tend to be less. And then you go to Europe, they tend to be less again. And we were in Amsterdam last week at another conference, and they're coming up. I mean, they're coming up, but historically they are step downs in different geographies.
And what's the appetite? We talked about the appetite from incumbents in using the tech, but what's the appetite now for acquisitions? Has that changed?
And
also, what's competition do you see from them in investing now?
Yes. So again, this can always change, and changes company by company, their individual situation. But we get phone calls from acquirers all the time, and we get phone calls from large incumbents who call us and say, we need a know your customer solution. We don't have one that works. Can you find one, and we'll agree to be the first customer, right? And we'll give them an X dollar contract. So I think their interest in finding better tech solutions to solve their problems. I mean, AML, know your customers, is an obvious one. I forget, you see different ratios of how much of it is of banks' operating costs, and many people don't feel like they have a good enough solution yet, or they don't have a full solution. So I think what we see is that there continues to be actually even greater and greater interest. What was the second half of your question, Anna?
I don't know. Well, if they're competing for investment,
oh, no.
Strategics, banks have and insurance firms have their own.
Yeah, no, we actually find sort of the corporate VCs to be very helpful. So many of them have joined us in investments, and they didn't exist a decade ago, or didn't exist anywhere to the same degree. And then they all vary in their ability to help the company. They all vary in their ability of getting the company at least the right introduction to the right party internally, or right party geographically. Their ability to deliver a commercial deal to a particular company, or maybe they follow the investment after they've done a commercial deal, and that means they got more buy-in. So they're very active. They tend to write, at least the ones we spend a lot of time, often a lot smaller checks than we'd want to write. So they want to follow you, or they want to come along with you, and they want to participate, and they want to gain from bringing their commercial deal, which is kind of understandable. So you see some competition from them, but it's more additive than it is, competitive.
Are there any problems you'd wish more startups were trying to solve? Is there an area where you wish there was a bit more activity?
Well, we think regulatory compliance, which now goes by the term RegTech, is going to continue to sort of have lots of problems to be solved, and that's kind of across lots of different use cases. We like we talked about with data earlier, red tech. I'd also add to that identity. I think the sort of what happens in terms of identity, I mean, as we all know, there's kind of document verification, and then there's identity verification, and then is that person. And as our lives all become more digitized, identity and managing identity is going to continue to be a big issue, and there are folks out there that are doing great jobs kind of aggregating parts of that, but actual solutions to that, we'll see. Fraud risk, we have one company in the fraud space that does very well, Feedzai out of Portugal. But we all know fraud is going nowhere but up and to the right? So there continues to be enormous opportunity in fraud.
What risks do you see for the fintech market this year?
What risks? Well, we all know valuations are high. We all know that we haven't had a credit downturn. So how is that credit downturn going to affect, lots of different solutions out there? And we have, two companies in the asset management space, Next Capital and Pagaya, both of which kind of have AUM models, basis points on AUM. So if the stock market falls in half, they and others like them, right, will have issues. Obviously, all the companies that use some portion of consumer lending. So if you have a credit downturn, many of these companies that have been formed in the last 5 to 7 years haven't lived through that. Now, if we even go back to 2008 and we look at our companies then, most of our companies actually accelerated during that period because they had a solution that was good either direction, either market direction. But that all remains to be seen. And then I just think, valuations, because it's not really in anybody's interest to have high capital intensive companies being built that are dependent upon another round being brought in case you have a downturn, right? And so it's a risk. If it's a good solution, we'll do just fine.
And what's your view on the likelihood of a recession?
Oh, I don't know if I knew that, Anna.
I know. Are you taking in practice? How are you handling the potential that it might be closer now? Because it's
a long time.
Definitely closer now than it was 5 years ago. We don't know when.
I know, but it's like the big earthquake or something. We always try to make sure our companies are prepared for, like everybody. You try to make sure everybody's positioned for whatever scenario might unfold. But again, historically, if we even go back to 2007, 2008, all of our companies actually accelerated through that. So you just have to make sure you have a solution that works in those kind of scenarios.
And I want to go back before we do the overrated, underrated, but I want to go back to before you mentioned one of the areas where you were cautious was open banking. And
yeah.
Can you maybe elaborate a bit on why? What's kept you?
Well, we should have said a great opportunity, right?
Okay.
We all should say great opportunity, we should be investing, which we did say, but because it means, the individual or the customer can port their information.
Yeah.
Easier, better, faster, right? What does that mean for incumbent traditional banks? What might that mean for new startups? But then could you leave the neobank and move to another one more quickly? What does it mean? Three of our companies actually provide data fraud solutions to manage the data there. So it was actually an opportunity, right? But what are going to be the fraud risks in and around this? So we've kind of just let it play out a little bit, but a few of our companies have actually taken the opportunity and sold more contracts because of it.
Okay. So let's go to the overrated, underrated portion. The first one is incumbent insurance companies.
So we think they're underrated. And I guess we have, I'd call it 4 investments in the insurance space right now. And someone once said to me, before there were hedge funds, there were insurance companies. And I thought that was a very funny line. But the fact that, most of those companies have a lot of capital, right? The incumbent insurance companies have a lot of capital. So it's not like the banks post-08, post-09. Now, most of the insurance companies are quite sleepy, right? And they're going to wait for everybody else to figure it out, and then they'll follow. But, they're sitting on lots of premium, lots of customers. And yes, it all has to be modernized. The technology stacks are decades old, right? But there's not a crisis and there's not pressure on them and there's not a capital issue. So they're buyers of our solutions and many insurtech solutions out there, right? And buyers of both the service and the solution as well as the acquirer of the company. And they're all going to be woken up, and there are areas such as commercial insurance to SMBs that are really antiquated. But I would not count the incumbent insurance companies out.
Cryptocurrencies.
No, overrated. No description, overrated.
With no explanation.
With no explanation.
All right. What about large technology companies getting into finance? That's kind of the fear everybody talks about all the time.
Yeah. And again, we largely invest in B2B companies where there's not that much of a risk, right? Direct-to-consumer companies, there'd be more risk. So, and they obviously have customer bases and media reach and everything else, right? Let's put that one neutral. It depends on what it is.
I don't know if neutral is allowed. But, Adyen.
Underrated. They've got a lot of scale.
RegTech, I guess.
Underrated, and we think there's huge opportunity.
And you already spoke about AI, so I'm going to ask you, the previous panel, was it overrated, underrated?
Oh, Hans? We'll call Hans underrated.
Okay.
Yeah.
Right. Thank you so much.
All right, thank you. Okay.
The next moderator is Jan Rapun from Axios.